Coming up, the RBA lifts interest rates. We take a look at the mortgage impacts and Westpac's profit results. All of that and more next. Hi everyone, welcome to the SBS On The Money podcast for this Tuesday, the 5th of May 2026. It's a day where the Australian share market fell, the S&P ASX 200 down 0.2%. We'll have the details with Todd Hoare from LGT Wealth Management in a few moments, plus Sally Tindall from Canstar on the impact today's interest rates rise will have on your mortgage. But first, to that decision by the Reserve Bank to lift official interest rates by 25 basis points to 4.35%. It's the third interest rate rise this year. To tell us more about why the RBA moved when the rest of the world hasn't, I spoke with PwC Chief Economist Amy Lomas. Amy, why did the RBA ultimately lift interest rates?
In my view, there's three key reasons for why we saw the rate increase today. Probably the first and the most substantive is that fuel price shocks in Australia flow through to macroeconomic inflationary pressures as opposed to destroying demand, if so to speak. So Australia has one of the highest per capita diesel consumption levels in the world. We're a very large diesel user, and the diesel that we do use goes into essential activities like manufacturing, mining, agriculture, etc. So there isn't a lot of room for users of diesel to switch to alternatives. So the higher fuel price just flows straight through and people just have to bear it. They don't have a way of avoiding those prices. So this is very much a fuel shock that flows into Australia directly into inflation. The Reserve Bank would have taken that into account. The other thing is that the underlying inflation rate is still above 3%, and that's something that the RBA can't ignore. And then the third element is that every day this war continues, inflationary pressure is building. So the world at the moment is surviving without 13% of the available oil that it would normally have. And we're drawing down on reserves in order to maintain demand at current levels. As long as those ships are not traversing through the Strait of Hormuz, we've got inflationary pressure building, and we could see oil prices lift quite substantially once those reserves are fully drawn down if the strait doesn't reopen.
Any indication of future rate moves?
Yes. Well, firstly, the Reserve Bank has published in its statement in monetary policy that we will see higher rates before the end of the year. So they're projecting, I think it was 3.7%. Markets were similarly at 3.7%, and then various different banks have forecast. I think there's even a forecast of 3.85%. So it depends what happens in the Middle East. That's definitely a factor, but I think overall we would expect to see more rate rises this year.
Can borrowers generally afford this?
So the household story is an interesting one. So households' savings ratios have actually lifted slightly in recent times, and there's no indication at this stage of broader defaults on mortgages or indications that households are struggling to pay. That said, they are having to make changes to their spending habits because the average household with, say, a $600,000 mortgage before today's rate rise was having to find another $300 a month just to cover the two previous rate rises plus the additional fuel costs. So households are having to adjust, but those households that are probably the most exposed, there is a small proportion. So there is a small group of households that would be finding it particularly difficult at the moment, but that's an isolated minority group.
The RBA seems to be at odds with other global central banks, which are generally on hold, some talking about potential rate cuts, and we're mainly talking about the US here. Why?
Well, there's a few reasons why. Firstly, if we go back to my previous point, Australia has one of the highest rates of diesel consumption in the world. We're a big country. We have a big freight sector. We have a big mining sector, a big agricultural sector. So liquid fuels are still a really important part of the Australian economy. So we are more exposed to the higher fuel prices than maybe other countries. So, for example, countries in Europe. That would be the first thing. The other element was just before the war broke out, the Australian economy was starting to lift. There was a really great momentum there. And in fact, it was one of the instances where as an economist, you could tell a positive economic story. And that was being driven by investment in technology, business investment and household spending. But it was coming at a price, which was that there was more demand in the economy than there was capacity to deliver it. And so that drove up prices. So we were already at a higher inflation level than many of our comparable countries before the war broke out. So that explains why we're in a higher place with our policy rate than other countries.
I think earlier when we were discussing the potential for future rate rises and you referenced the RBA saying 3.7%, I think that's what they mean when they compose their economic forecasts. That's the assumption in terms of its economic forecast when we see the statement on monetary policy. This time last year, the RBA had forecast the trim mean inflation would stay at 2.6% from June 2025 through to 2027. That didn't happen because even before the war, the actual trim mean inflation rate hit 3.3% in December 2025. Its fresh release of economic forecasts out today has trim mean inflation peaking at 3.8% in June and staying above 3% until mid next year. How did the RBA get inflation forecasts so wrong?
All right. So there were two factors in my view, and the RBA was quite open about the first, which was that there was a point in time about 12 months ago where the RBA assumed that there was a higher level of productivity in the economy than there actually was. And so there was a point where the Reserve Bank adjusted its productivity assumptions down to reflect what it determined was probably a more accurate reflection of the productive capacity and the efficiency of the economy to produce things. The second element goes back to that good news story that I mentioned before. Business investment, particularly investment outside of mining, rose very rapidly towards the late part of the calendar year 2025. So much so that the Commonwealth Treasury increased its business investment forecast outside of mining from 1% growth to 4%. So it quadrupled its forecast in its mid-year review for business investment. That's how fast it grew, well ahead of what anybody expected. So we had businesses feeling confident about the future and investing, and particularly investing in better systems and technology. And we had an adjustment to this assumption around productivity, and the two came together, and that meant that we got caught, I think, a little bit short on the expectations around inflation.
What about the government spending side of the story? The Treasurer said today the RBA statement does not point to public spending as a factor in the RBA's thinking to lift rates. Is this true?
Yes, so I've had a bit of a look through the statement on monetary policy, and I think I can agree with the Treasurer there. There's nothing in there that I could identify that was specifically singling out government spending as a factor. And then when you look at the proportion of growth that's attributed to government spending versus private demand, or public demand versus private demand, and trade, for example, it's not forecasting anything particularly severe in terms of the contribution of public demand to the outlook. So I don't think there's anything particularly different to the outlook and the expectations around government spending, but obviously we're waiting to hear what happens next week with the budget. Obviously there's going to be some changes. The government has been pre-releasing those, and it has definitely communicated. The Treasurer has definitely communicated that he understands the need to be cautious around government spending.
Amy Lomas there, the Chief Economist at PwC. Let's take a closer look at the Australian share market now, which did fall. The S&P ASX 200 down 0.2% to 8,680. For a look at the day's market action, including how investors reacted to the RBA decision, I spoke with Todd Hoare. He's the Head of Public Markets at LGT Wealth Management. Todd, how did the market react to the RBA's decision to lift interest rates? And is the market now bracing for further rate rises?
Well, Ricardo, this time the vote was 8-1 in favour of a hike. And if you remember back to March, the board voted 5-4 in favour of a hike. So a much more unanimous decision this time around. It might suggest, I think, at the margin that the focus has shifted a little. Maybe they are a little bit more worried about the inflation side of their mandate at the moment. But it's probably also worth remembering that that March meeting was really when the fog of war in the Middle East was at its greatest. So there was some genuine uncertainty about the timing and the trade-offs of a rate hike. So potentially that vote is less about the RBA's conviction levels and more about the timing of rate hikes. To answer your question, the market was already 80% priced for a hike heading into this decision. So there was little to be gained by not following through this time around. Traders are fully priced for at least one more rate hike this cycle to 4.6%. Ironically, that'll take us to where we were at the peak for most of 2024. I think from a market's perspective, investors are acutely aware of the potential trade-off that we're seeing. There are already signs of softness across the consumer. We've got falling conditions, falling confidence rather. We've got pressure from energy prices. So there is clearly a bit of a trade-off that the market is trying to brace for at the moment. The risk of a policy mistake, I would argue, is arguably higher here in Australia than it is in other parts of the world. But with that said, there were some comments from the minutes this afternoon from the RBA that would suggest that they're also not deaf to the trade-off that we're seeing at the moment. They said there's plausible scenarios where inflation is higher and where activity is lower than expected. So it is really a two-sided argument at the moment, but with a focus clearly on inflation.
And I guess there was that one line at the end of the statement that basically implied it's well positioned to go one way or the other, need it be. That's interest rates. What about the ongoing uncertainty in the Middle East? They're flowing through to inflationary pressures down the track. How are you as an investor managing that, especially as we head into confession season, because a number of companies have already warned about the impact that the war will have on their bottom lines?
Yeah, we've been discussing this a lot internally, and we're viewing the transmission mechanism, I think, primarily through its influence on energy, and then in turn, from a macro perspective, how central banks might respond to that. But you make a good point. There's also that second layer at a micro level, which is where companies are most affected. Are they able to protect margins? So I guess the focus gets, skewed a lot towards the geopolitical side of things. But for us, we're a little bit more focused on the release valve and where that key transmission mechanism is. It's clearly energy through higher oil prices. They are a tax on households. It's a cost increase for companies. And for Australia, there's been a lot of work that suggests that the fuel cost drag is much larger than a single 25 basis point rate hike. So it really does matter here in Australia for consumer spending, for freight costs, for margins, and ultimately earnings guidance. And you mentioned, I think, the impact on Aussie corporates. We've already seen that. Cochlear, with a 40% share price move last week, called out the Middle East. The banks have actually been increasing their collective provisioning and calling out the possibility of some weaker economic conditions as a result of the Middle East. Accent Group delivered a downgrade yesterday. So we are starting to see some impact there at a corporate level. For us, we're underweight Australia. We think it's comparatively harder to invest marginal dollars here than it is elsewhere. And so where we are directing money here, it has to be towards those companies that have some pricing power. They've got strong balance sheets. They've got resilient demand. Maybe they've got their input costs already priced. And we're probably a lot more cautious on earnings that rely on discretionary spending, where the consumer, although resilient, is arguably going to find it a lot more tougher from here.
If you're implying that you're looking offshore, does that include the States where we're seeing, shares hit record highs. I mean, they were down overnight, but they're basically at record highs despite the conflict. I mean, isn't there a sense, a little bit of optimism there, or too much optimism?
Well, it's probably going to be a narrow window. So the longer this conflict goes, you're right, the greater the prospect that legitimate optimism gives way to complacency. We think there's valid reasons why markets, and in particular the US, have reacted how they have. Exogenous shocks, particularly geopolitical ones, tend to be buying opportunities, and we've already seen the constraints that both the US and Iran have in terms of ongoing military action. And what that meant was that it actually allowed investors to move very, very quickly away from, the risks associated with the Middle East and onto what actually drives share prices. And that was on the global earnings outlook. And so far, corporate earnings, particularly in the US, have been very, very strong. They've been very, very resilient. Obviously, there's a lot of AI-related spending and monetization on that front, and it has been very, very powerful. Financial conditions have actually been easing rather than tightening, which is a little bit counterintuitive with where oil prices have gone. But you're right, the longer that the Strait of Hormuz stays closed, the greater the margin pressure, and therefore the greater the risk that central banks may have to actually tighten into all of this. And potentially the fact that if they do that, we may look back in 2 to 3 months and say maybe markets were a little bit complacent. So I guess to summarize, we would argue that the easy Middle East de-escalation gains have probably been made. And from here, we probably actually have to see some de-escalation, or at least the strait opened and traffic flowing through it again.
Back locally, you just touched on the banks as well. We heard from Westpac, which posted a half-year profit of $3.5 billion. What do you make of it? And what does it say about the way businesses and consumers are dealing with this higher interest rate and inflationary environment?
Yeah, so Westpac had actually pre-announced a lot of specific items. So there probably wasn't a great deal of new information that would change one's perspective. Revenues were okay. Net interest margins probably a little bit weaker, but in the main, broadly where we would expect. The positive, bad debts all within expectations. Credit quality trends actually look reasonably benign. The balance sheet's pretty well capitalized, but all of the banks are actually increasing their collective provisioning. They're all calling out the prospect that the economy over the second half will weaken from here. And we all should realize that monetary policy acts with a lag. And so these rate hikes that the RBA is putting through at a time where there is cost of living pressures is going to be a bit of a headwind for the domestic economy, subject to what comes out in the May budget.
So finally, what are you telling your clients then, and where do you see the opportunities for investors?
So I guess at a high level, we're telling our clients not to panic, but also not to be complacent. As per our discussion a minute or so ago, we're obviously in an environment where inflation risk has clearly re-emerged. Growth is strong, but probably a little bit more uncertain than what it was a couple of months ago. And the longer that this geopolitical risk keeps going, the risk increases that it directly feeds into energy prices and into central bank policy. So I guess for us, the opportunity is to use any volatility to upgrade portfolio quality. Look for companies with structural growth, with pricing power, with strong balance sheets, where they can pass on those price increases and protect margins. And I guess as we just touched on before, we still have an overwhelming preference for international markets over Australia for now. It does look like Australia, from an investment perspective, is going to be a much more difficult place to make appropriate returns than it will be in other parts of the world.
That's Todd Hoare there from LGT Wealth Management. Now to the impact on borrowers of this rate rise. And Canstar says for an owner-occupier with a $600,000 25-year mortgage, the rate rise will add $91 a month to minimum repayments. It's more than $150 for those with a $1 million loan. However, of course, this isn't the first rate rise this year. So if you add all three, it means an extra $453 since February for those with that larger $1 million loan. So if you have a loan in this environment, how do you know if it's a good one? For more on that, I spoke with Sally Tindall from Canstar.
This is going to hurt borrowers across the country. The May hike for someone with a $600,000 mortgage for 25 years to go, they're looking at an increase to their minimum monthly repayments of $91. But of course, we've had 2 rate hikes in February and March. This third one across all 3, they're looking at an increase to their minimum monthly repayments of $272. Not just as a one-off expense. It's not a bad trip to the dentist. That's something they're going to have to pay every single month for the foreseeable future. Now, $1 million debt, it's a lot more pain, and plenty of people in Sydney, Melbourne, Brisbane, they're lugging around those size debts. They're looking at an increase of just this one hike of $152 to them a month extra on their minimum repayments. But across what is then 3 hikes, it's $453 extra. That's almost $1,000 more these people now have to pay on their mortgage if they don't go out there and get themselves a better deal.
Sally, this also means, though, that borrowers can borrow less. Their borrowing capacity shrinks. It comes at a time, however, when home values are falling in Sydney and Melbourne, for example. What does it mean for them?
So every time the RBA lifts rates, the maximum amount someone can borrow from the bank typically gets a haircut. And for the average income earner, you're looking at about a drop to their maximum borrowing capacity of about $12,000. But again, we've had 3 hikes now. So for that individual on an average income, they're looking at a drop to their maximum borrowing capacity across those 3 hikes we've now had of over $36,000 as an estimate. That's not a haircut, that's a buzz cut, particularly for couples, because, the drop is basically double for 2 people earning the average wage. Now, we have already seen prices start to slide in Sydney and Melbourne as a result of the rate cuts, but also a drop in consumer confidence. You only have to go to an open home to know that there's less people around, because borrowers have hit their ceiling because of the rate hikes, but also there's lots of buyers there that are thinking, I'm just going to sit on the sidelines and wait it out to see how the chips land, not just with the RBA and the rate hikes, but also the war in the Middle East. Will it turn into a landslide? Highly, highly unlikely, particularly in hotspots like Sydney, where there is still this stickiness between supply and demand. And if you're looking around the rest of the country, talking about Brisbane, Perth, to some degree Adelaide, well, they're defying the rate hikes despite the extra pressure on new borrowers because of that supply-demand equation. It is so far out of kilter there, and buyers have not hit their ceiling yet. So they keep bidding more in order to make that bid the winning one.
Okay, for those borrowers that are now looking at their loan thinking, can I get a better rate? How do you know if you've got a good rate at the moment, just as the banks prepare to pass on this rate rise?
So I would say go and check your mortgage rate today. Don't do it next week where it all gets muddy because some banks start passing on the rate hikes sooner than others. You might not be comparing apples with apples. Check your rate today. Understand what it looks like, because before the RBA and the banks pass this hike on in full, the average owner-occupier is on an estimated variable rate of about 6.01%. You want to be below that. As an owner-occupier, you want to be as far below average as humanly possible. And right now on our database, there is over 40 different lenders offering at least one variable rate under 5.75%. That's a really good stretch target for an owner-occupier. But no, those rates are set to climb in the next couple of weeks.
Obviously, higher rates are good for savers, right? But what's the outlook for rates, especially if someone is looking to fix as opposed to float their mortgage rate?
Yeah, it's an interesting time for people that are just looking for a ceiling, because we've had the 3rd cash rate hike in as many meetings. We've got Westpac forecasting more still to come. For some borrowers, they just need a ceiling to be put onto their mortgage repayments because the cash flow, the budget is no longer adding up. And so fixing might bring some security, but know that the ceiling isn't low at this point in time when you're looking at a fixed rate. Gone are the days of fixed rates starting with a 4. Gone almost other days of fixed rates starting with a 5. We've got 12 lenders on the Canstar database still offering one fixed rate that starts with a 5, but those rates have a target on their back now that the RBA has hiked yet again. So if you do decide to fix, shop around for a competitive rate. There's a world of difference between an uncompetitive fixed rate and a sharp one, but also know, yes, it will protect you from further cash rate hikes. But if the economy starts tanking, if job losses start happening en masse, the RBA could well revert to having to cut the cash rate again. And if you're still within your fixed rate term, you're going to miss out on those variable rate cuts.
That's Sally Tindall there from Canstar, and she wraps up the podcast for this Tuesday. Give it a like, a review, and subscribe if you enjoy it. And don't forget, you can watch On the Money during the 6:30 edition of SBS World News on SBS. The podcast returns tomorrow. It drops after the market close every weekday, and I'll catch you then. This SBS On the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decisions.